Hello everybody, Luke Gromen, founder and president of Force for the Trees, FFTT. Thanks for joining me. Sorry, a couple minutes late. Was hoping to catch the second consecutive Cleveland Browns win since, well, the last time that happened, I actually had a full head of hair akin to George Clooney. So hopefully they hang on to win. But at any rate, wanted to stick with our new format, run through two things that grabbed our attention recently quickly, and then open up for questions for a few minutes. Thanks to everyone watching this on replay. Two quick things. First off, China September factory growth grinds to a halt as export orders tumble. Reuters reporting this weekend that new export orders shrunk at the fastest pace since February of 2016. The story, goes on to discuss that it's a sign that the tariffs put in place by the Trump administration are beginning to bite. And clearly that is the case. The thing that grabbed us about this is that it's potentially a very important signpost. And by that I mean unless we see, let me back up. It would be very difficult for supply chains, corporate supply chains, to be restructured quickly enough that this is purely a Chinese problem. It's, I guess, potentially possible, but unlikely. But at any rate, we'll know if that's what's going on here is if we see an explosion in export order growth in other Asian sourcing markets, Vietnam, etc. If we see that, then we'll know this is corporate America restructuring supply chains in a big hurry. If we don't see that, then what this tells us is that the U.S. economy is slowing down pretty dramatically, or will in some of the data coming up soon. And that will be, I think, a very important milestone, both as it relates to Fed hikes and as it relates to U.S.-China trade tensions. So let's watch that. The second thing that really grabbed our attention recently, just found it fascinating, having done this business, been in this business for nearly a quarter century at this point. You just sometimes see things that kind of, tick off your spidey sense. And for me, in the last week and a half, we've had Ray Dalio and Stan Druckenmiller give lengthy interviews in which they explicitly warn about U.S. debt and deficits and the risks to the U.S. economy, the global economy, in very explicit terms. And also, over this weekend, we've had the second annual gathering of the MMT Conference, our second annual, or second ever MMT Conference, our Modern Monetary Theory Conference. And I'm not doing MMT justice in simplifying this for 90 seconds, but it's effectively deficits don't matter, until they matter. When you have two legendary investors saying they're going to start mattering soon. So to us, it was very a little reminiscent of the famous 2007 when Citigroup CEO Chuck Prince saying, when the music's playing, you got, as long as the music's playing, you got to get up and dance. And George Soros famously retorted that the music's already stopped. And so, to us, you've got this MMT conference in New York talking about, hey, we got to keep dancing. There's more we can do on the deficit side. And you have these two legendary investors, one of whom is obviously a protege of George Soros, saying we're already bumping into some trouble. So those are the two things that really grabbed my attention at this point that we're watching as we're heading into the trading week. As I'm sitting here waiting for questions, if you guys have them, happy to take them. In the meantime, if you're interested in kind of what we're up to, FFTT-LLC.com. Also, you can sign up for our weekly Tree Rings product there. And let's see what kind of questions we have out there. Thoughts, insights on Real Vision interview with Stan Druckenmiller. Hi, Andrew. Good to see you. Hopefully Monday's going well for you. I watched it Friday night, and it was Absolutely tremendous to watch. If you haven't watched it, what Andrew's talking about, Real Vision did an excellent, really unprecedented interview. Kirill Sokolov, who's a legend in the investment research business, and I think one of the most brilliant minds in humanity to be. I don't think that's an overstatement. But at any rate, he interviewed for 90 minutes on Real Vision Stan Druckenmiller, one of, or if not, one of the most legendary investors of all time. And they talked about a wide-ranging view of topics. I think. Look, I think Stan sees some of what you're seeing in terms of the near term with emerging markets being the weak point initially. I thought it was really interesting when they talked about, this, we refer to it in our writing as the Druckenmiller playbook, right, which is the run bigger deficits on the fiscal side while you're tightening on the monetary side. And he goes into that in some detail in the Real Vision interview as it related to the German mark after the German Deutschmark after reunification in the late 80s. It was originally a movie they had seen before in the early 80s with the United States. And what I thought was interesting is Kirill kind of pushed him on it. And, Stan's point was, we're already pretty well into that process. And so I thought that was a really interesting point he made from the standpoint of this, strong dollar short squeeze. Druckenmiller clearly seems to be aware of the trade, but his appraisal of where we are in terms of what inning we are in this seemed to be, reading between the lines, later than a lot of people I think I've seen talk about it. And so that was interesting to me. There's a number of other really interesting points he made within that. If you don't have a Real Vision subscription, I would check it out. It's a tremendous interview. Let's see. What are your thoughts on SDRs as the international settlements currency? Hey Eric, how are you? To me, if you take a step back, go back to early 2009, Zhao, the head of the PBOC, talked about, in no uncertain terms, in fact, he was absolutely explicit, the dollar's the problem, we need a neutral settlement asset when this all settles down. And then once it all settled down, we did do the IMF reforms in 2010. The U.S. finally passed those through Congress at the end of 2015. To me, they would work depending on how they are structured. You would, instead of settling, you would settle imbalances in SDRs, and then if you change the weightings as the IMF over time or all of a sudden, you could reorder currencies based on a balance of payments perspective. And as you look at the basket of five, the challenge as you look at the basket of five SDR currencies is that if you're not settling in dollars, then you start really moving towards this multilateral currency system. And if you're moving towards a multilateral currency system, you're going to be basically, currencies are going to begin moving back towards trading on the economic fundamentals that they traded on for centuries, which is to say balance of payments fundamentals. The country with the highest surplus and the biggest pile of reserves had the best currency. And that was the way it worked for centuries. Last 50 years, we've been in this upside-down system where the country with the worst, with the lowest pile of reserves and the biggest deficits, not surpluses, has the best currency, and that being the dollar. And so if we start moving, I think mechanically it's pretty simple. It's not easy, but it's pretty simple to move towards SDRs as international settlements currency. Mechanically, politically, it's not easy. Mechanically, it's pretty simple. But then if you look at what that would imply, all of a sudden the dollar would be the dirtiest dirty shirt, and it wouldn't even be a close race. You look around the world, nobody's running twin deficits anywhere near the size we are. If they're running even a single deficit, you'd probably rank the big five SDR currencies as number one would either be yuan or euro. Number two, three would be yen. 3 would be the pound, and 4.5 would be the dollar. So you'd be the dollar would have to fall the most under such an arrangement, which is, I think, why we haven't seen it, or why it's so politically tricky. So to hollow out its domestic economy to run the deficit supply of the yuan the world would need for, and that's ultimately why I think the yuan and the euro, if you look at how they're structured, those are the other two currencies that could theoretically take the mantle of world reserve currency from the dollar. It's not going to happen, though. Neither one of them want that mantle, because it would force them to hollow out their domestic manufacturing and infrastructure to run the deficits needed to supply the world the currency, which is what the United States has done over the last 50 years. Let's see. Also, what happens if U.S. starts to increase its physical gold reserves other than price increase? Ultimately, I think it would be very good for the United States. I think one of the things we have said repeatedly has been, if we woke up tomorrow and gold was $5,000 an ounce, I think most people would be surprised at how fixed the world is, not how broken it is. However, though, there would be some massive sector rotations within that, where you start moving away from debt-fueled consumption, finance, government spending in the United States, and start moving back towards more production-centric industry, intellectual property, etc. Stuff for within the United States. And so, if the U.S. started to increase physical gold reserves, there are some, most people don't want to admit it, but there's some big political connotations to that in terms of why are the Americans buying gold, and so I don't think you would see that outside of some sort of extreme emergency. Poland and gold buying, right on the heels of EU and Iran. This continues to be probably the most ignored story on the planet by most mainstream economists, which is to say, since 2013, global central banks have net sold about $25 billion worth of treasuries, and they have bought on net about $120 billion worth of gold. Most of that has been quote-unquote rogue nations like China, Russia, Turkey, Venezuela, Mexico, but then you also lump into that, though the $120 billion does not include the gold repatriated by Germany, the gold repatriated by Austria, the gold repatriated by the Netherlands, and now you have Poland buying. In recent weeks, you've had both India buying for the first time in a decade, the central bank. You've also had Iraq's central bank buying gold. And so it's pretty much everybody but the Americans and certain other Anglo allies, whether it's Canada, UK, that have not. At some point, this is going to matter. Given the structure of the gold markets, it's not going to matter for the gold price. If anything, it's a negative for the gold price because you're removing physical collateral from a highly levered paper gold market. It's basically a run on London and New York physical gold by central banks that don't like the way the world's worked under the current currency system, whether that's defensive out of concern about the weaponization of the dollar, or whether it's offensive. I can make a pretty credible case either way, but to me, it's another big hint on something going on in terms of undercurrent, in terms of change in the global currency system. Let's say China would not hollow out its domestic, but use the offshore yuan tradable for gold as reserve. The way that they have set up their system is, to our eyes, is very it's elegant. It looks like what's going on in London and New York is effectively a London gold pool 2 arrangement. We've tweeted about this a number of times. If you're not familiar with the London Gold Pool, the first iteration, I would take a look at that. You can Google London Gold Pool, read up on it. But effectively, gold was fixed at $35 an ounce, and back then you did not have paper gold markets that you could use to manage that process. You had to sort of shuffle gold around the world, and it was being shuffled around out of central banks through London to try to kind of keep a lid on gold price as U.S. deficits were getting out of control associated with the Vietnam War and Lyndon Johnson's Great Society. something similar appears to be happening. Central banks, monetary authorities have a lot more weapons in the arsenal to be able to fight this. It's not just move gold around. You've got highly levered gold futures markets. You've got unallocated markets that are very opaque, which is a fascinating thing in a time where financial regulation is as high as it's ever been. The physical gold market remains extraordinarily opaque. But the point is the elegance of the Chinese system is that once gold's inside mainland China, it's not allowed to leave. If it's in Hong Kong, it can come and go. If it's in the Shanghai International SGEI Free Trade Zone, it can come and go. In Dubai, yuan gold can come and go. But what this ends up happening is it ends up as either the yuan falls in value, or if as more commodity trade is settled in yuan, to the extent that there aren't balancing trade, to the extent commodity exporters into China end up with yuan surpluses, those can be exchanged for gold at any of these places, but that gold's got to come from a non-mainland Chinese source, which by effectively default is London or New York. And so you can see it in the flows. You've got this, slow motion, basically run on physical supplies going on in London and New York. And it's not going to matter till it matters. And if anything, it's a negative for the gold price, and we continue to say that. And that is going to be the case until, one moment in time, likely binary political decision is made where it's no longer negative. All right, let's see. Any more questions out there? Looking like no other questions out there right now. So, hey, thanks for jumping on. It's always great talking on a Sunday night. Good luck to everybody this week, and we will catch up and see you guys soon. Hopefully, go back downstairs and see that my Browns have closed out the game. Oh, hold on, one more. Do I think? Hopefully the question is not just do I think. All right, guys. Hey, we'll catch you next. Oh, do I think that gold has bottomed for at least the year? The price on our screens, I continue to think, hasn't been a real market since at least 2013, since at least mid 2013, and maybe early 2013, and that's really when the physical demand has spiked up for gold and created this removal of collateral dynamic, really akin to what we saw with Lehman in 2008. We've gone through the period of time of the anniversary of 10 years, people reminiscing about their remembrance, but as it relates to what we're talking about in the gold market and this physical demand, why it doesn't matter until it matters, why it's actually negative for paper gold prices in the near term, is the way to think about it is that when Lehman creditors began demanding more collateral from Lehman, it wasn't positive for Lehman, for the price of Lehman liabilities, for the price of Lehman stock, even though demand was rising for Lehman collateral. That was a bank run, and that's what's happening here. To the extent that that gold is flowing east from traditional gold trading centers, London #1, New York's a much smaller market on the physical side, but you can see the physical flows. It's clear as day. And where it's going to Switzerland, and then it's going east because the Swiss government reports the data. You can see this slow motion run happening, and so you're pulling collateral out of a highly leveraged system in much the same way as creditors were pulling collateral out of Lehman in 2008. And again, it didn't matter until it mattered, and then once it mattered very quickly. And I think that this type of situation is setting up in much the same way. And so, to answer your question directly, I don't mean to talk around it, but I do think it's very important to understand is if you own gold, this is what you're dealing with here. This is how that market is structured. And so I continue to think gold is the credit default swap of this cycle. I think it gets repriced enormously higher. I think it could get repriced enormously higher in a very short order. But I also think that could happen tomorrow, or it could happen 3 to 5 years from now. And so you just need to be cognizant of that. And in the near term, I think gold probably does not that much, because it's going to you're continuing this run. Also, there's some management. The lower it goes, the more you're going to spur buying from the 4 to 5 billion people in Asia that they're going to buy gold on weakness. So that'll only make that collateral problem worse, not better. So I think it probably doesn't do a whole lot. It'll be a tweet this time. Yes, they won't interrupt Bonanza. The president won't preempt Bonanza, or maybe it's Sunday Night Football. Yeah, it'll be a tweet. So, all right, guys. Hey, thank you very much again. Always great catching up. Again, check out FFTT-LLC.com. More information. Other ways, you're welcome. Thank you very much for the positive feedback, Adrian. All best, and we'll catch up with you guys next Sunday night. Have a great week this week, guys. Thanks again for tuning in.